long long-term care insurance. Long-term care insurance basis. Long-term care insurance pays for services to help individuals who are unable to perform certain activities of daily living without assistance or required supervision due to cognitive impairment such as Alzheimer's disease. Features of long-term care policy. The best policies pay for care in a nursing home, assisted living facility, or at home. Benefits are typically expressed in daily amounts with a lifetime maximum. Some policies pay half as much per day for at home care as for nursing home care. Otherwise, others pay the same amount or having a pool of features benefits that can be used as need. Criterion for beginning of payments. The policy should state the various conditions that must be met. They can include the ability to perform two or three specific activities of daily living without help. These include bathing, dressing, eating, toileting, and transferring or being above to able to move from place to place or between a bed and a chair. Cognitive impairment. Most policies cover stroke and Alzheimer's and Parkinson's disease, but other forms of mentally incapacities may be excluded. Medical necessity or certification by a doctor that long-term care is necessary. Most policies have a waiting period or elimination period. This is the period that begins when an individual first needs long-term care and lasts as long as the policy provides. During the waiting period, the policy will not pay benefits. The policy pays only for expenses that occurs after the waiting period is over. If the policyholder continue to need care, in general, the longer the waiting period, the lower the premium for the long-term care policy. Benefit period for long-term care may range from 2 years to a lifetime. Premium can be kept down by electing coverage for 3 to 4 years, longer than the average nursing home stay instead of a lifetime. Most long time terms care policies pay an on a reimbursement or expense incurred basis up to the policy limit. In other words, if the policy has a $150 per day per benefit, but the policyholders spend only $130 per day for a home long-term care provider, the policy will pay only $130. The extra $20 each day will in some policies go into a pool of unused funds that can be used to extend the length of time from which the policy will pay benefits. Other policies pay on an indemnity basis. Using the same example as above, an indemnity policy would pay $150 per day as long as the insured need and receive long-term care services regardless of the actual outlay. Inflation protection is an important feature, especially for people under the age of 65 who are buying benefits that they may not use for 20 years or more. A good inflation provision compounds benefit at 50% a year. Without inflation protection, even 3% annual inflation will over 24 years reduce the purchasing power of a $150 daily benefits to the equivalent of $75. Six other important policy provision. Elimination food. Under some policies, if the insurer had qualifying long-term care expenses on one day during a 7-day period, he or she will be certified with having stratified 7 days towards the elimination period, the time between an injury and the reception of payment. This type of provision between an injury and the reception of payment towards the elimination period, the time between an injury and the reception of recipient of payment. This type of provision reflect the way home care is often delivered, some days by professionals and some days by family members. Guaranteed renewable policies. These must be renewed by the insurance companies, although premium can go up if they are increased for an entire classes of policyholders. Waiver of premium. This provision insurance that no further premium also due once the policyholder starts to receive benefits. Third party notification. This provision stipulates that a relative, friend, or professional advisor will be notified if the policyholder forget to pay a premium. Known for further benefits. These benefits keep a lesser amount of insurance in force if the policyholder lets the coverage lapse. This provision is required by some states. Restoration of benefits. This provision ensures that maximum benefits are put back in place if the policyholder receives benefit for a time, then recovers and goes for a specified period, typically 6 months, without receiving benefits.